Alphabet is spending money on a scale no company ever has. Management just guided next year's capital budget as high as $205 billion, nearly all of it aimed at artificial intelligence infrastructure. On the day that number landed, the stock dropped 7%. Free cash flow has cratered to $53 billion. The 8-year buyback streak has been paused. So here is the question that decides everything. Is this the sound of a moat widening or of returns quietly eroding? By the end of this, you will know whether that colossal bet is paying off, how a business still built on search advertising actually earns its money, what the balance sheet and cash flows really say, and where a fair price sits against today's $318. Alphabet runs the world's most used search engine, the largest video platform, the Android ecosystem, and a cloud arm now growing faster than either of its two bigger rivals. Yet strip away the variety, and roughly 3/4 of every dollar still traces back to advertising. The revenue split makes that concentration impossible to miss. Google Search and other alone brought in $224 billion last year. Add YouTube ads and the Google network, and advertising is about $295 billion. Cloud, at $59 billion, is still the junior partner. Think about what that dependence means. Roughly $1 in every $1.35 hinges on people typing a query into a Google box and clicking a sponsored result. Anything that changes that habit attacks the majority of the business at once. That is the whole risk in one sentence. The top line is the rare part of this story. Revenue climbed from $258 billion in 2021 to $403 billion in 2025, and the trailing figure now reads $446 billion. For a company this size to reaccelerate past 15% is genuinely unusual. Earnings have compounded even faster than sales, the fingerprint of operating leverage. Diluted earnings per share rose from $5.61 in 2021 to $10.81 in 2025, a 17.8% annual rate. The trailing figure looks larger still, but it is inflated by investment gains worth ignoring. The margins tell a story of discipline recovered. Gross margin has widened every year toward nearly 61%, and operating margin climbed back to 32% after the 2022 spending binge. The uncomfortable question ahead is whether the depreciation wave from all this building erodes that. Returns on capital remain elite, but the trend just inflected. Return on invested capital ran above 22% for years, peaked near 26% in 2024, then slipped to 21.8% in 2025. That dip is the arithmetic of a swelling capital base racing ahead of the revenue it will earn. The balance sheet remains a fortress, despite the noise about borrowing. Net debt sat at just $28 billion at the end of 2025, against a company earning over $130 billion in operating income. Leverage near 0.2 times means this borrowing is a choice, not a necessity. Here is where the strain becomes visible. Operating cash flow has surged past $185 billion, yet free cash flow has gone nowhere, actually falling to $53 billion on a trailing basis. The gap between those two lines is the entire infrastructure war. The cause is one number exploding. Capital expenditure jumped from $25 billion in 2021 to $91 billion in 2025, and a staggering $132 billion on a trailing basis. That now swallows more than 70% of operating cash flow versus a comfortable 27% back in 2021. To fund that build, something had to give, and it was the buyback. Repurchases ran above $60 billion a year through 2024, then fell to $46 billion in 2025 and just $17 billion on a trailing basis. The 8-year streak of buying every quarter has effectively paused. Those buybacks did real work while they lasted. Diluted share count fell from 13.55 billion in 2021 to 12.23 billion in 2025, roughly a 10% reduction that lifted per share value. That tailwind is now largely switched off. The dividend, begun in 2024, remains a token gesture. Per-share payouts went from 60 cents to 83 cents, with a trailing rate of 85 cents and a yield around 0.3%. It signals maturity, not a meaningful return of capital. Still ahead, whether today's price makes sense and the single risk that could break the whole thesis. But first, why is this franchise so hard to attack? The answer is written in the returns. 5 straight years above 20% on invested capital does not happen without a moat. The advantage stacks in layers. Search feeds on scale and data. Android and Chrome put a Google surface in front of billions daily, and YouTube links creators and viewers at a scale no rival matches. The newest layer is the deepest. Alphabet owns its own AI chips, models, and distribution. The backdrop matters here. In a world where money is no longer free, a $200 billion spending plan on depreciating assets faces a far higher bar than it would have in 2021. With a beta of 1.25, this stock amplifies every market swing. The cycle that actually applies is the AI infrastructure build-out, an investment supercycle where the giants race to lay down compute ahead of demand. That phase is cash-hungry across the whole industry, and the market's nervousness is a shared fear that the returns arrive later and smaller than promised. Positioning tells its own story. The shares sit at $318 against a 52-week range running from $189 to $403, roughly the middle of the band, and well off the highs after that 7% drop. Sentiment has cooled from euphoric to skeptical. The competitive read, though, is encouraging. Google Cloud grew 82% year-over-year last quarter, outpacing both larger rivals, backed by a $500 billion order backlog. Against that sits a fresh securities investigation tied to reports that a flagship AI model is running behind schedule. Signal versus noise. So what is all of this worth? Rather than extrapolate depressed free cash flow, the cash flow case assumes revenue growing near 15%, capital spending easing toward 20% of sales, and free cash flow rebuilding toward $120 billion. Discounted at 9%, that points to $295 to $360. Blend that cash flow view with a forward earnings multiple and an enterprise value to EBITDA check, and the three lenses converge on a fair value range of about $298 to $358. At $318, the stock trades inside its own band, just below the midpoint. Wall Street's numbers are bold. Consensus revenue reaches $490 billion this year and $693 billion by 2028, growth around 20%. Yet earnings per share barely move from $14.78 to $14.87 next year, the market pricing a margin squeeze as depreciation lands. On operating profitability, the cleanest cross-check, the picture is stretched. Enterprise value to EBITDA hit about 21 times in 2025, near the top of its 5-year range. Today's price already credits the Reaccelerating analysts' forecast, which leaves little cushion if that growth disappoints. What would break the thesis? The dominant risk is that the capital spending simply fails to earn its return. It would show first in the numbers already softening, return on invested capital sliding below 18%, while spending stays near 30% of revenue. Then the compounding story flips. The second risk aims straight at the crown jewel. Generative AI can answer a query without a sponsored click, and Alphabet is cannibalizing its own interface to stay ahead. If search monetization erodes even modestly, it swamps everything cloud contributes. Regulators circling the default agreements only sharpen that threat. So moat widening or returns eroding. On the evidence, Alphabet looks fairly valued. It trades inside a fair value range of roughly $298 to $358, just below the center. The business beneath is exceptional, but the price already credits the reacceleration everyone expects. This is an educational analysis, not investment advice. Every figure here comes from public filings and estimates that can change. Do your own research before making any decision with your own money. If this breakdown helped, subscribe and tell us in the comments which company we should analyze next. The tension in this one, spending versus returns, is worth watching quarter by quarter. Thank you very much for watching, and we'll see you next time.